primary driver of world financial market sentiment over the weekend was news that the Spanish had gone to the European Union seeking around 100 billion euros in bailout money. What drove the market sentiment was not so much that they went to the European Union, but that the European Union actually handed the money over. Spain actually needs that money, not so much in terms of the government itself, but in terms of propping up its ailing banking situation. Of course, the Germans trotted out that same old line: if you want the money, you've still got to push through the reforms, which may be difficult because, of course, the reforms are very, very bitterly opposed in Spain. Across in Greece, further evidence of the Greeks' ailing economy. In terms of inflows to Greece, they reached around 700 billion euros for the month of May. Now that's up around 50 billion euros on the previous month. Also some signs that other parts of the Greek economy is also in trouble. The Greek energy companies in particular are beginning to show signs of stress. DEPA, which is the government's gas company, is in fact having to scrabble around to private banks to raise funding to pay off Gazprom, the Russian gas giant, and that's in order to keep gas flowing into Greece. So looking at the actual impacts on markets then, the Dow Jones was up on Friday. However, most European indices were either flat or down. In terms of currencies, the Kiwi was up against the US dollar, back through the 77-cent US barrier, but down slightly against both the Aussie and the Euro. There were some interesting details in Sheep and Beef New Zealand's report on movements in sheep and beef farm input prices. Now basically that report shows that, as would be expected, farm input prices have increased over the year to 31 March 2012. It's led predominantly by the increase in fertiliser, lime and seeds, up around 7%. However, it also shows that interest costs have gone backwards by around 4%. The report concludes that over the last 5 years, farm inflation has been more than 22%, and that compares against the CPI of around 15%. Looking at that figure around interest, the key question is this: is it because the farm debt of the respondents has gone backwards, or is there some reason in terms of interest rates actually going downwards? Looking at Reserve Bank of New Zealand data to 30 April 2012, total rural debt in New Zealand has actually increased by around $1 billion. So what that means is that interest rates have actually gone backwards. There are potentially a number of reasons why. However, one of the most likely ones is that farm incomes over the last couple of years have been high. And what that's meant is that serviceability of the debt has actually become easier, which has resulted in an increase in credit quality, and that's potentially put some downward pressure on those interest rates.